I'm Bill McWilliam, President of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is real estate consultant Ross Kay from the wealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks a lot, Jim.
I heard the greater Toronto area is reconsidering a foreign buyer tax to cool off the market. Is that a good thing to look at?
Foreign buyer tax, it's the same situation that we had there with Vancouver in British Columbia. The government should not take any action at all while a housing market is in its upward trajectory. What they need to do is let the market peak, roll over, and then once it reaches its trough on its current trading cycle, only then should they ever apply any governmental changes to any aspect at all that impacts the housing market. That means taxation, that means interest rate changes, that means changes to the lending rate environment. The market should be allowed to run its course because what my firm knows is every market will run its course. So the government steps in and takes an action midstream, and it's not that it has unintended consequences because the market doesn't change. All it may do is quicken the pace of change, or it can cause a little bit more damage to be done. They cannot institute any changes mid-cycle that is going to reduce the damage. The only changes that they will make will cause more damage to occur. So it's, as you found out in BC, listeners to your show know, foreign buyers vacated your market months ahead of the foreign buyer tax being coming into place. After the fact, the BC government was lauded for the slowdown in foreign buyer market share being recorded by government data. Of course, the government data was stale dated months because the government reports closing sales, where the sales that were impacted by the tax all took place before the tax was even being talked about. So the government is now looking at tweaking your rules again, and they're looking at that because they're heading into an election, and they are going to be blamed for the current $280 billion drop in net worth in the province of British Columbia. By the time they're going to the polls, that news will be forefront in the population. Everybody will be fully aware of what's already taken place. And actually the damage behind the scenes, as I said last week, is probably almost $100 billion more than that by the time the voting goes on. So to bring in the same change in Ontario would be a foolish move by the government, because the Ontario market currently is still on its upswing of the current trading cycle. It is going to turn over. That is unavoidable. So I don't think I'd want to be blamed for that, especially the Liberal government here in Ontario, who has made so many mistakes over the last few years. I don't really think it would be a smart move for them to make further changes. But as the BC Liberals thought, they could garner some positive press if they were to attack foreign buyers with this tax. My question is, where are the foreign owners? Why does the government simply not start talking about foreign owners? Because the government has that data in their back pocket.
Are foreign buyers bidding up Toronto real estate, and what country are the majority of foreign buyers from?
Foreign buyers are not bidding up Toronto real estate. Toronto real estate is simply following a housing bubble cycle. They are in the overinflation portion of the bubble, which happens before a market turns. That's where you're seeing year-over-year record-setting house price gains in terms of average purchase price, which is simply a result of fewer and fewer people being able to move in the market, trade their existing home for another one, meaning those that are trading in each category of homes are those with a little bit higher income, and as fewer and fewer people of the lower income segment in each category can no longer afford to move. In other words, they won't be approved for the financing. Creates the illusion of a more house price gain. The bubble gets bigger. And the way to describe it is housing markets really don't function like a bubble. They function like a tsunami. So you are at the tsunami in Ontario now is cresting. So this tsunami has gotten so large that it's going to have to roll over. Once it rolls over, we know what the consequence of a tsunami is, total devastation. And as the wave pulls back out, which is symbolic of home equity, then you look at the damage that was left behind from the tsunami itself. So we don't like to use the term housing bubble. We like to use the term a tsunami because it's more reflective of how home equity flows through a housing market.
So it isn't foreign buyers pressing up Toronto prices?
No, foreign buyers, you've got a market the size of the GTA. The foreign buyer count would have to be so high. What I mean is there's only about 230,000 homes turning over in the entire province of Ontario right now in a given year. So the percentage of those buyers to impact the price would have to be, like to impact the market, would have to be somewhere around 20%, meaning there'd have to be about 40,000 foreign buyers entering the market. In the same way that we explained to everyone why that data did not exist in British Columbia, and we still know in British Columbia, foreign buyers were still only accounting for about 6% of the market, which you will find out come July, and you've got a full year's worth of data there. In Ontario, you're probably looking at about 3%. What everybody doesn't understand is the Canadian Real Estate Association back in 2014, I've never really talked about this before on the show. In 2014, they came out with a form called the Individual Identification Information Statement or form. And and it was created specifically way back in 2014. So there was a form before that for about a decade, and then the 2014 update came along. The 2014 update actually was a 3 or 4 page document. One of the checkoffs in the Canadian Real Estate Created form specifically states high risk, and then there's a checkoff for foreign citizens, foreign buyers. So that form has been existent now for 3 years. Those forms were communicated to the entire real estate community by the Canadian Real Estate Association. So the mere fact that those forms have never been collected by the government or FINTRAC is the big question. The reason when the real estate boards say, well, we completed a survey of our members and they indicated they don't need to complete a survey of their members. Simply ask, how many of those forms did you complete where you checked off foreign owners or foreign citizens or foreign buyers? Because they are designated specifically on the form as high risk. Such high risk that if you check that off, you have to let the compliance officer in your real estate office, which by law in Canada, each real estate brokerage must have a FINTRAC compliance officer designated. You would have let your officer would have known that had been checked off, so that he could have made sure that you had made the right filings with FINTRAC yourselves. Obviously, that form has never been discussed in any single media report issued since 2014. Certainly was never talked about during all the discussion in British Columbia. No one brought up the fact that CREA had created that form 3 years ago. The form exists. I have it. There's no argument about it. It was supposed to be completed, as I've said on this show before. So if the foreign buyer myth was true, there would literally in Ontario need to be about 40,000 of those forms filled out last year. That would keep the FINTRAC office running off their feet. Those forms have not been supplied. So either you're going to see thousands of realtors and thousands and hundreds of brokerages being charged with FINTRAC, or it's simply a myth. We know there's no hole in the financing in Ontario, where we saw a hole in the financing in British Columbia. So we know that hole doesn't exist in Ontario, so there was not an impact in the market that it's impacted house price inflation at all there.
We've heard the housing market was most exposed to risk on higher interest rates. Ross, what do the metrics you use offer on that premise?
Well, and that's really what I wanted to talk about today, because, I put a poll out there asking people what their opinion was of what has been reported as the biggest risk of popping Canada's housing bubble. And if you look at all the newspapers going back to 2013, including comments and statements from the Bank of Canada and the Ministers of Finance, it's always been that rising interest rates hold the greatest risk to a housing market. Now, I've always known that is like the most ludicrous comment I've ever heard about a housing market, and I know I've used that term lots of times, ludicrous comments about the housing market. But in this case, it simply is so ignorant to how the housing market works and how home buyers interact with the homes that they purchase that, I really couldn't believe that the Bank of Canada believes the nonsense that they actually put in their reports. So I would encourage all your readers to go back and download the Bank of Canada FSR report from the last quarter of 2014, where they made the comment at that time about Canada's housing market being between 10 and 30% overvalued. And we know housing prices have gone up about $90,000 on average. The average purchase price has gone up by $90,000 since that report was given, meaning that their overvaluation of 10 to 30 is now somewhere between 30 and 50%. But those are the Bank of Canada's own words. Rising interest rates risk the market. This is a falsity, because what you're actually talking about when they talk about rising interest rates stalling the housing market or causing housing prices to roll back is actually the monthly cost to own a home. In other words, interest rates are irrelevant unless you have a mortgage. When you have a mortgage, then interest rates become relevant. But interest rates do not dictate what your payment is going to be in terms of the homes that are being sold or purchased, and how the housing prices are rising. So what I mean for that is this. This current cycle started in around 2013, and where housing prices were around $360,000. And we're sitting now today around $490,000 is where the average purchaser is paying for a home. The difference between mortgage payment from when this cycle started in 2013 to where we are today really means the interest rate could have risen 2.51%, and your mortgage payment would have been exactly the same as if you purchased a home today, it would be at. So if this, 2.51%, that's almost a doubling of mortgage payments from back then, when you could get a 5-year term for around 2.75%. So you're looking at a 2.5% rise in interest rates, which I think generally everybody would say, since it's doubled, that would meet the criteria that the Bank of Canada has mentioned. But the fact of the matter is, the average payment being made by the purchaser of the average home from 2013 till today equals as if the same thing as if interest rates had risen that 2.5%. In other words, the payment would be exactly the same had prices stayed where they were, and interest rates had risen to 5.2% for a 2.5% gain. This is why it's a myth that rising interest rates will pop a housing bubble. A housing bubble is not popped by rising interest rates. It's popped by ownership costs. Once the cost to carry a property under the average amount of money that is borrowed to purchase a home exceeds the income or qualification levels of the average person who's buying the home sales stop. Excuse me. They stop overnight. There's no magic bullet here. This is simply real estate math. So when the Bank of Canada made those comments back in the spring of 2015 in reference to the market as it had existed in the fall of 2014, you would have already saw the housing market collapse because the effective carrying charges have increased that amount. It is a myth that you need rising interest rates to pop a housing bubble. It is the monthly carrying charges which pop a housing bubble. Sooner than later, every single real estate market reaches a point where there is not enough new capital coming into the market and there is not enough borrowing power left in the home buyers for housing prices to continue to rise. Initially, you'll see a smaller year-over-year gain in selling prices until it reaches a point where there's a rollover. When the rollover happens, that's where negative house price actually start being recorded. So in Vancouver, your rollover was last September. It has not rolled over here in Toronto, although the metrics look like it's very close. You're seeing that by fewer first-time buyers entering the market, which creates the illusion of greater house price gains because the average purchase price naturally increases if there's fewer first-time buyers. The number of sales in the sales chain needs to increase because first-time buyers are no longer propping the market up and smaller steps are needed to reach the ultimate purchase price. The quality of home that is being purchased is so low today that the actual house price gain is crazy. We're recording sales right now in the GTA where the housing prices, the houses are now selling for, listen to this, over 70% more than what the home would have appraised at last March. Over 70% gain. All of that's hidden from the public because they use the term average selling price, which is actually only talking about the average purchase price, meaning the amount of debt and equity that's being carried forward in the market. So, the myth of rising interest rates will pop the housing bubble is a false. It is not true. The truth is that it's a combination of rising house prices and mortgage debt increases that make a property a bubble end. They all end the same way. You cannot avoid them. It's simply a fact.
We'll have more with Ross Kay right after the break.
Gem International is a new diamond explorer in the richest diamond producing country in Africa, located next to the fourth largest producing diamond mine in the world. International Spotlight is on an 1109 carat diamond recently discovered in Africa by a fellow Canadian junior with a proven operator and finance team. Gem International trades on the TSX Venture Exchange, symbol GI. Visit us at gemdiamondmining.com.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Welcome back. We're speaking with Ross Kay. Ross, are mortgage insurers and banks in Canada opposing risk sharing on mortgages and starting to point fingers? Is this a bad sign for the real estate market?
When you're talking about peak pricing, or you're talking about the top of the tsunami wave, then it's always a bad time for a housing market. And when you have all of these people going around spouting off comments, self-interest, I really don't. It's so ridiculous when we hear these people talking, and the fact that apparently the government believes everything that they say. It's a really bad time for the housing market. When you have all of these people who are making comments that they cannot support with data, your listeners need to understand that. When an economist or housing analyst talks about a housing market, they are making a guess. They can't give you a statistical calculation or metric to prove what they're saying. They're relying upon your own ignorance on a housing market and your need to hear the truth that you'll believe anything that they say. And they don't know what they're talking about. And I'm sorry, I apologize. It is universal, the ignorance that exists out there. So when they're making these comments about risk sharing, this is a little bit about like the TD Bank telling their tellers that you've got to raise your profits by doing whatever it takes to get TD customers to pay more money. Now, apparently, nobody knew that was going on. So something that's gone on for 25 years, apparently nobody knew what was going on. Now, it's gone on in the mortgage market for longer than 25 years, but it's certainly gone in at the bank level for over 25 years, and we've always counseled our own clients to be looking out for these sort of things as homeowners. What we're hearing here today is about this risk sharing. Well, risk sharing, first of all, it's a myth. It doesn't need to happen. Canadians make their mortgage payments. What you're going to see is simply, instead of decreasing amortizations over people's lifetime of home ownership, if interest rates rise, which they're going to be rising probably for the next 20 years, you're going to see a lengthening of amortization happen to allow people to continue to live in and pay off their mortgages. This is not a complicated process. It is not even a bad process. As long as the homeowner knows the truth and they can make a rational financial decision on what choices they make, this is not bad news. It's bad news is when they're making mistakes like this, listening to the banks and the realtors and the economists who don't know what they're talking about. It's a massive mistake when that happens. So when we hear this comment about risk sharing, who's going to share the risk? It's going to be the homeowner. The banks will pay nothing. Any cost the bank has will simply be rolled over to the homeowner, the person taking out the mortgage. It won't cost the bank a nickel. And the person taking out the mortgage will simply decide whether or not they want to take that risk-sharing cost on top of their mortgage. In other words, CMHC simply could have raised CMHC fees, CMHC mortgage insurance fees. That's all they had to do. But instead of doing the right thing and making that decision, they have decided, okay, we're going to hide the gain by letting the banks charge it. This is a very complicated topic. It's complicated because there's so many stakeholders trying to make personal gains or financial gains for the corporations in this discussion. It's really not something that I should be trying to attempt to discuss here on the show. What I can say is that it is all economists. The consumer is being conned in the same way the TD Bank tellers conned TD clients into doing things to make TD more money, taking money out of the client's pocket.
We'll have more with Ross Kay right after this.
I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're chatting with Ross Kay. Ross, are bank tellers under a lot of pressure to sell mortgages, and is that pressure legal?
Is the pressure legal? Sure, it's legal. The Articles of Incorporation for every Canadian bank is that the bank is working for the bank shareholders. You know, the banks can run any advertisements they want on television about how great things they're doing for their customers. Look, they're a customer. They are not clients of the bank. The bank does not owe them any due diligence. The bank is going to take them for every nickel that they can so that those earnings onto the shareholders via dividends and higher bank stocks. That's why the banks have simply, without care, loaned out such exorbitant amount of mortgages being backed by CMHC, so the bank had no risk. They didn't care about their clients. They didn't care if young couples were overextending themselves. They didn't sit the clients down and say, look, if the interest rate goes up 2% at the end of the 5-year term, you're probably not going to be able to carry this same property any longer at the current amortization. But this is what will happen if rates go up 2%. Although you will have paid off 5 years of your current mortgage, what we'll be able to do as your interest rate increases in 5 years from now is we'll be able to re-extend your amortization back out to 25 years, thus lowering your payment while still covering that higher interest rate. So don't worry, you won't lose a house, just our bank will make more money. Should we expect anything different from a teller who can move you from a $9.95 a month checking account to a $29.95 checking account that whereupon you drop below $5,000 of savings, all of a sudden you start to pay? No, you shouldn't expect anything different. What I do think should be prosecuted, though, is when these changes took place without the customer's approval. And apparently, in some of the reports that I've read, that has taken place. Now, that would be a fraud, and I think the government itself needs to investigate that one.
Ross, thank you so much for chatting with us.
Hey, thanks a lot.
My guest has been real estate consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HowStreet.com radio. If you have any questions, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.